In this example, we will see the role that inventories play in the free cash flow formula. SoulCycle is a fitness company that offers indoor cycling workout classes. One of SoulCycle's revenue sources is branded workout gear. Suppose that SoulCycle purchases 10,000 tanks at a price of $20 each in 2013. In that year, SoulCycle sells 5,000 of the tanks, and in 2014, the company sells the remaining 5,000. The price of these tanks is $52 each. The corporate tax rate is 35%. What are the free cash flows in 2013 and 2014? For simplicity, ignore all costs other than the cost of goods sold or COGS. Before applying the formula to obtain the free cash flows, note that SoulCycle buys all the tanks in 2013 and then sells the same number of them in 2013 and 2014. We should therefore get a lower cash flow in 2013 when the tanks are paid for than in 2014. Now let's apply the free cash flow formula. Recall that free cash flows equals NOP minus the change in net PP&E minus the change in net operating working capital. First, let's compute NOP. For this, we need EBIT. SoulCycle sells 5,000 tanks at $52 each in both 2013 and 2014. Each year, sales are 52 times 5,000 or 260,000. Since SoulCycle bought the tanks at $20 each, the cost of goods sold in each of these 2 years is 20 times 5,000 or 100,000. EBIT each year is therefore 260,000, that is the revenue, minus 100,000, that is the cost of goods sold, or 160,000. Taxes on EBIT are 35% of 160,000 or 56,000. Therefore, NOP is EBIT of 160,000 minus taxes on EBIT of 56,000 or 104,000. Note that NOP is the same in both years. We know that the cash flow in 2013 must be lower. Clearly, NOP alone does not reflect the true free cash flows. The reason here is that accountants subtract the cost of the tanks, that is the cost of goods sold, in the year in which each tank is sold and not in the year in which the firm actually pays for the tank. To solve this timing issue, we include the change in net operating working capital. First, note that there is no investment or depreciation in this example, and hence, change in net PP&E is 0. Also, the only item of net operating working capital we have is inventories. The firm starts with an inventory of 0, buys 10,000 tanks in 2013, and in that year sells 5,000 of them. Therefore, the inventory at the end of 2013 is 5,000 tanks. Since the firm bought each of them at $20 each, inventories at the end of 2013 will be 5,000 times 20 or 100,000. In 2014, SoulCycle sells the remaining 5,000 tanks, so that inventory at the end of 2014 is 0. The change in net operating working capital is plus 100,000 from 2012 to 2013 and minus 100,000 from 2013 to 2014. We now apply the free cash flow formula to obtain that the free cash flow in 2013 is 4,000 and in 2014 is 204,000. This is precisely what we're expecting. a lower cash flow in 2013 than in 2014.